Hi guys, welcome to the YouTube channel, The Novel Trading. I am your trader and trainer, Mr. Goel over here. So I hope that you are enjoying our basic learning series in the Forex market, as this 7-day mentorship is a whole decorum about what is Forex market and how you can make profits in Forex market by regularly trading in it. So in this video, I'm going to talk about a comment in which I received a very important query and I wanted to make a separate video about it as to make it properly understand about the whole concept, and you should not get confused with it, guys. So in the day 2 of this mentorship series, I received one query in the comment section. The Weber commented that how does the leverage really works in the market when we are dealing in the Forex market. So let's say if the leverage is 100x, how much money are we putting there? Does the company pays the amount here? And what if I made a big loss? Would it affect the leverage equally? I'm going to properly make you understand with the help of an example of how the leverage works in the market. So when you're regularly trading in the Forex market, you should understand this concept very deeply, because this leverage is the major reason why 95% of the traders blow up their account. So in this video, we are going to focus on this question: how does leverage in the Forex market works properly? So I'll be sharing an example in front of you so that you can understand how the concept of the leverage actually works when you're regularly live trading in the Forex market. Okay, so let's start the example, guys. Let's say you deposited $100 in your broker account. Okay, I am just expecting that you have just opened up the broker account and you have still not opened up the broker account. There is a link in the description by which you can open up your account and regularly trade with it, and you're also going to receive some benefits with it. So coming back to the example, let's say you deposited $100 in your broker account. Okay, now you want to trade in Euro USD. You're finding a good buy opportunity technically and fundamentally in the Euro USD. So in this example, the current market price of the Euro USD is 1.180. I believe that you already understand the concept of the pips, because this whole example is based on the pip format. If you do not understand what is pip, you can go to a YouTube channel and properly watch the video where I've showed you with examples what is pips and how you can calculate it. Okay, so basically in this example, the current market price of the Euro USD is 1.1180 and your expected target is 1.1280. That means you are going to take a buy and you are thinking that the price will go towards the upside and will go to this price level. So over here, if you will look at this difference, the difference is about 100 pips in the market. You are expecting that if you are going to buy at this price level, you are going to make a profit till this price level. Okay, so from 1.1180, your expected price target is 1.1280 in the market. And to manage your risk well, you have put up the SL on 1.1150. So if you're buying at 1.1180, your SL is for 30 pips in the market. Okay, so let's say if you're right, you're going to gain 100 pips in your profit. If you're wrong in your perspective, then you might be losing 30 pips. So now let's connect the pip calculation along with the position size and understand how does the leverage works in the market. So in this example, we have understood that I have bought this Euro USD at this price, and if my trade goes right, I'll be gaining 100 pips, and if my trade doesn't go right, I'll be losing 30 pips in the market. Okay, so over here what I've done is I've taken a very simple example for you so that you can understand how is the leverage is affecting your trading. Now over here you can see that if you're right, you're getting 100 pips in the market, and I have already told you that if you're trading in pips, then one lot will give you $10 profit in the market. Okay, one lot will give you $10 profit in the market, and one lot is equal to $100,000. Okay, one lot is equal to $100,000. So if you have just deposited $100, or small money traders like me and you don't have the power to buy $100,000 by ourselves. Okay, so what does the Forex brokers do is they help you by giving you loan in the form of leverage. So let's say if you have deposited $100 and the broker is giving you a leverage of 100 times, that means what? That means your total trade value can go up to $10,000. So let's say if I have this trade and I know that this is a very good quality and good probability trade, so what I want to do, rather than just making a trade for $100, I want to trade bigger and I can use the leverage for the same. So my trade value can go up to $10,000 with the help of the leverage itself. So with the help of the leverage and my deposit, I have $10,000 from which I can buy what? My position sizing can be 0.1 lots in the market in Euro USD. That means $10,000. Now we are going to discuss two situations in this market. Situation one is price reaches your target. Okay, what happens when the price will reach your target? How the maths will work? So let's understand this. So if the price reaches your target, your buy price was 1.1180 and your current market price, because the price has moved up, your current market price is 1.1280. So over here we have covered a distance of 100 pips in the market with a position sizing of 0.1 lots in the market. That means For every pip increase in the market, I am going to be receiving $1 profit because I'm trading in 0.1 lot. Let's say if I would have been trading in one lot, then I would have got $10 in the market. Rather, because I was trading in 0.1 lot, I'm getting $1 for every pip movement towards my direction. Since this was a 100 pip momentum, what did you receive finally? You received a profit of $100 in the market. Okay, so over here, your capital is increased by $100. If you will look at the returns, you had a return of 100% in the market. And this happened because you had leverage. Let's say if you don't have leverage in the market and you're having 100 pips, then with just a deposit of $100 from your side, you will be able to only gain $1 as your profit in the market. So because we want to trade big, we want to make good money with our small money itself, we are using the concept of leverage provided by the brokers for free of cost. So this is how you can make $100 profit from a $100 deposit with the help of leverage itself. Now let's consider situation number 2. So if you're considering the situation number 2, the price reaches the stop loss. Now in this situation, we are expecting that rather than going towards the upside, price has gone against my direction and has given me a loss. Now over here, your buy price was 1.1180 as before, but your SL was where? Your SL was at 1.1150. That means this is a difference of 30 pips in the market. So now when you're losing, you're just losing 30 pips. Okay. So what would be your loss size if you are trading in 0.1 lots in the market? So now over here, just properly understand this. If you are losing 30 pips with 0.1 lot positioning, you are losing minus $1 for every pip. Okay. Since this was a 30 pip stop loss in the market, you will have negative $30 as your loss in the trading account. So after $30 loss, your final balance will be $70 out of $100. So whenever you're having losses in the market, the losses are not going to be a part of broker's capital. He's just providing his capital to give you a leverage. That means you can trade big position sizes with small money. But whenever there will be losses, it will not be equally divided between you and your broker. Rather, the whole loss or the whole profit only belongs to you. The broker is not going to take any percentage of the profit or the losses. Just because he's providing you leverage for taking the contract doesn't mean he wants to contribute to your capital or he wants to be a participant. He's just helping you so that you can take big positions with small capital available in the market. So in this situation, when you hit your stop loss, you had a loss of $30, which will be deducted from your balance, your deposited balance. So as your deposited balance was $100, now you have $70 left because you incur a $30 stop loss. Now I'm giving you a very, very simple hypothetical situation over here so that you can understand this very important concept as well. Let's say your buying price was at the same level, let's say 11.180, and your SL was 1.000. So that means what? You have put up a SL of 180 pips in the market. And whenever you are losing $1 per pip. So if you're putting this stop loss, if you're putting the stop loss which is bigger than the size of your account balance, what is going to happen? So hypothetically, your loss should be minus $180 if the price goes against your trade, right? Because you have put up a stop loss of 180 pips in the market. So what will happen? Let's say if the market is really going down and you are losing the pips in the market, the price will never touch your stop loss. Why? Because you only have a deposited balance of $100. So that means what? That as soon as your $100 are over, that means you made a loss of $100. Your position or your trade will automatically stop and you will have zero balance on your account. The trade will never be able to reach 1.000. Rather, the price will do what? The price will automatically cross at 1.1080, which is 100 pips far from your trading order. So if you bought at 1.1180 and you had a balance of $100, your order will stop at 1.1080. So even if you are putting your stop loss sizing more than your account balance, it doesn't matter because the broker will automatically cross your trade in the market and you will be having as much losses as you have deposited in the account. Okay, so broker is not going to participate in your loss. That is what you have to understand. The broker is just giving you some amount so that you can take a higher position. He is not liable for your losses, neither he is taking your profits as well. Let's say if you make $100 or $180 profit, he is not going to take any percentage of that as well. So I believe that this was a very basic query, but it is highly important because many people who are entering into the forex market doesn't understand the concept of leverage and how does it work. So I believe that with this video, I'm able to make you understand the concept of leverage and how does it work. And if you still have any query, you can put it in the comment section. So I'll make another video to make you more understand with the help of more examples in the market. Okay, so leverage only lets you buy or sell the trade. Please guys, remember this. Leverage is not the participation of your capital into your trading account. It will only let you buy or sell in the trade in the account. Okay, so this is how the concept of leverage works in the market. I hope that you are able to understand what is happening in the market, how the leverage is actually working. So if you want to know more about this trading concepts, you can contact us on this WhatsApp number. I also give one-to-one personal session, guys. So if you genuinely want to become a trader and you're looking for a mentor, you're on the right path. You can contact us for your doubts, for your clarifications, and I hope that I'll be able to help you as much as I can. See you in the next video, guys. Good luck to you, traders.